So you want to start investing? Congratulations, I think that's such a huge move forward. But before you start, I definitely think this video is gonna help out a lot. In today's episode, I'm gonna take a look at 3 things I wish I would have done before I started investing. If this is your first time here, my name is Najarro. I am a stock market investor with over 6-figure portfolio trying to share the knowledge to others. Like always, make sure to hit the thumbs up and the subscribe button. Now let's get started. So the way this episode is going to be broken down, I'm going to share 3 things that I would have done before investing. And at the end of this episode, I'm also going to share, let's say if I had X amount of dollars, how I would invest that money right now. So the first thing I would do is actually pay down my credit cards. And now let's take a look at why I would do that first. The average credit card interest rate is about 17.87%, almost 18%, right? And I'm pretty sure some of you guys might have credit cards that have a higher interest rates than that. Some of them could be as high as 24, 25, 28, 29%. And why would I pay this off first? The first reason is if we take a look at the average stock market return per year, it's only 10% per year. So let's say you had $100 to invest right now and $100 in debt. Mathematically, and I'm going to show right at the end of this episode, maybe sometimes mathematically might not be the best decision in the long run. But mathematically, the first thing is it makes more sense to pay off that credit card debt because you're paying a lot more in interest than you are gaining over time. So that's tip number 1, super easy, pay down credit card debt. Tip number 2 is also not that difficult to understand. It's saving a cash position. And here, I mean, everybody has a different level of cash that they want to save up. I do believe it's a great move to have some form of cushion room. Some people like to save maybe a month expense, 2 months expense, 3 months expense. I think for everybody is a bit different. You understand maybe what type of career you have. Maybe you have a career that you feel you can find a job pretty quickly. So maybe you only want to keep like 1 or 2 months of extra savings. Maybe you believe your job is not as stable and you might not have an easy time finding another job. Maybe build up a 3-4 month time savings of cash, right? And why is cash important? The first thing about the stock market we're going to see, it's very, very volatile. It goes up, it goes down. And unfortunately, the times when it really goes down, for example, here we can see between February 2020 and March 2020, the stock market dropped like crazy. What was happening during this time? COVID situation, right? And during COVID situations, a lot of people lost their jobs. A lot of people weren't able to work. So I do believe it's important to have some form of cash position because let's say normally bad things, the stock market goes down when bad things happen. So the last thing you would want to do is do any form of what I call emotional investing. And it's when you get fearful and kind of sell all your stocks for a loss. That's the last thing anybody wants to do. And unfortunately, like I mentioned, that type of fearness comes when something bad is happening in around the world. So now let's take a look. Let's go back to that COVID situation. Let's say you had invested all your money during the COVID situation and you didn't have any form of cash account. You didn't have any form of cash available. What would have happened when COVID starts? Your most likely scenario is you would have sold out all your stocks because you needed to build up some cash just in case some emergency happened. And because the way the stocks moved, you would have sold for a loss. So by having a cash position, it would have allowed you not to sell that stocks and not to sell out for a loss. So I do believe having a cash position is the second important thing to do. All right, so now tip number 3 that I wish I would have known is remember, this is a long-term investment, right? Money here in the stock market, you're not going to be rich overnight. You're not going to be rich over the next few months, over the next year. Wealth accumulates over time and it grows and grows over time, right? And just like we saw in this chart, sometimes that road can be super bumpy. It goes up, but there's days when it goes down. So by remembering that, hey, this money I am investing is money that I'm not going to see maybe for the next 5 years, it allows you to not worry too much during these downturns. Because if you outwait, and historically, if you wait out these downturns, in a matter of time, your returns will be stronger. So that's a fine thing. Remember that this is long-term investment and that the road can get very bumpy. Sometimes it could be very, very scary, but historically, time is on your side. All right, so now that you guys saw my 3 tips, let's take a quick look at some actual values, right? I think listening to tips is good, but sometimes we have to see the numbers ourselves. So let's say every month I have $150 to invest, right? But let's say I had credit card debt. Obviously, credit card debt, like we saw, is the most important thing to pay because that's where most of your money is actually going. So I would use a huge chunk of this cash to pay down credit card debt first. And even though mathematically it makes more sense to use all that money to pay that credit card debt, I think the human mind likes to be repetitive, and doing something over and over and over again kind of creates this kind of natural thing for you. So even though we are paying down that credit card debt, I personally would also put maybe $25 on cash, right? I'm getting used to every month putting money into that savings account. I would also put $25 to invest, right? So a big portion would be credit card, some to savings account, some to invest, right? Because the credit card is the biggest impact. But now what is happening? Now you're getting used to putting money into your savings account. Now you're getting your feet wet at investing. So now that you're getting your feet wet at investing, you're learning what's good to do, you're learning how to purchase, and you're getting some experience along the way. Eventually, what's going to happen? Eventually, you're going to pay down all your credit card debt, so you won't have any more debt. And I am going to do a video later on how to work on paying down that credit card debt. But now you have $150 to save on cash and invest. I would split it up. $75 to cash, $75 to invest. Now you're really building up that savings account to have some form of emergency fund, right? And you're also putting more money to work and getting that feet wet a little bit more. Eventually, what's going to happen? Eventually, you're already used to saving that $150, but you already saved the amount of emergency fund you needed. So now you can put all that money to invest, and financially that money is going to grow over time. But building up that routine of saving into a savings account, of saving into investment, and paying down that credit card, that routine, in my opinion, does a lot well when you do it over and over. And eventually, what's going to happen? You're going to get a raise. You're going to learn ways to save more money. So maybe months, instead of 150, you're going to be saving $200. Now you already have no credit card debt. You're already happy with your cash position. Now you're going to be building that account even stronger and stronger over time. But I do believe it starts with the mindset of investing, of saving for cash, and making sure you pay down that debt. So that's it, right? Today's episode was pretty simple. It's just 3 tips that I would do before investing. And I do believe these tips can help you out in the long run. So I hope you guys enjoy. Make sure to hit the thumbs up. Make sure to subscribe. Take care and see you next time.